really focusing on the local universities and trying to create relationships with them. So I teach in the finance department at USF, I teach in the economics and finance department at St. Mary's. I'm on the faculty for the real estate program at San Francisco State, and I teach in the graduate school economics and finance at Golden Gate University too. And I'll be teaching at all 4 universities next semester. The other third of my time is in wealth management. I focus mainly on real estate principals and professionals. My focus is on, how do you take the cash flows coming out of the real estate and where do you put them? I do recommend, if you have multiple assets, set up a property management company and first thing you do is do a defined benefit program and plow like $250,000 pre-tax into your retirement program. And you can deduct everything through that too. So I help people with that business model. I've also been focused on trying to get people out of real estate. The private annuity trust was a great structure. They took it off in 2006. The coupled installment sale or monetized installment sale, I think, is a viable structure. It's becoming very popular. And then you obviously have the straight and the reverse 1031 exchanges. I can also advise on the oil and gas leasehold interest, the TICs, and the Delaware statutory trusts. And obviously, the deferred sales trust is your fallback position when it looks like your exchange is going to fail. I also partnered with Mark Rakovic. I don't know if anybody knows Mark. He was with Marcus in the 80s, 30 years experience, can do deals up to, 40, 60 million. So he and I are working on some institutional transactions, and we've been doing that for about a year now. And I basically hired 5 of my students, and I'm going to build out a brokerage platform with those guys and get them all licensed. So that's what I'm working on right now. So let's get going through the presentation because we got a lot going on. But let me get right to the chase because everybody asked me, when's the next recession? 2018. When's the next severe recession? 2021 through 23. So if that's the case, you basically have 2.5 years to basically get your shit together and basically create structures and portfolios that are going to be defensive. Okay, the next recession will probably be mild because it'll be a mid-cycle recession. But we have had a recession, and I have the data, in the first 5 years of every single decade, going back 150 years or post-World War II. 90% probability of a recession in the first 5 years of every single decade. It's like clockwork. So if that's the case, then we're going to have a severe recession in 2021 through 23. Why? Because there's massive sovereign debt that's been built up on a global basis, and there'll probably be massive sovereign bond defaults. And that's going to ripple through the economy, ripple through the financial institutions. You now have negative interest rates in Japan, you have negative interest rates in Europe, and Janet Yellen has already told the banks you better stress test a negative interest rate environment if we go into a recession. Negative interest rates are the worst monetary policy ever conducted, ever in history, and it's unprecedented, and there's no history, no theory, and really nothing to back it up. And the Japanese could get away with it because they're export-oriented, and the first thing that happens when you go negative on your interest rates is it devalues your currency, makes your exports cheaper so that you can export more and grow out. Okay, and they did it, and they're a wreck right now. And Europe is actually doing it. Also, it seems to be holding up a little bit better there. But again, if we do negative interest rates here, you're screwed. Okay, investors are totally screwed because sovereign bond yields will be negative. So if you buy negative yielding bonds, you're going to be worse off in the future. And the banking institutions will start to see disintermediation because they're going to be buying government bonds that are negatively yielding for liquidity purposes, and they're going to have to pay depositors some kind of positive interest rates to hold deposits at their bank. So they have deposit costs, and they're getting negative yielding bonds that they're investing in, and that's going to eat right into the interest margins, affect the stock price. The stock prices are going to go down, the debt levels are going to go up, and they're going to have to put up more capital, and they're going to stop lending. So it works for a little bit, but again, at the end of the day, it becomes very ineffective. Let's do it at the end. So that's basically my, right off the bat. Everything I say, I'm not making any recommendations, I'm not selling any product, I represent my own views and not the views of my company, obviously. Real estate is like a big wave surfing. You have to be fit, you have to be smart, you gotta educate yourself, you gotta position yourself, you gotta be able to get up and ride those big waves, and occasionally you're caught inside and you get totally wiped out by the breakers. But then you can pop up, you do it again, you paddle out, you position yourself, you ride the next wave. It's very, very similar. And I know a lot of people that have gotten wiped out, I know a lot of people that have gotten up and did it again and been very, very successful. So it takes practice. And somebody needs to time me. So how much time do I have? And I need somebody to give me like 30 minutes, 20 minutes, 10, and 5.
Okay, I'll do that.
Okay. So let's just do a global assessment. We know we're in the elections right now. Okay. It looks like Hillary's going to take the presidency because she has enough electoral college votes. All right. So that's done. So she's out basically politicking for Democrats to try to win the Senate and try to win the House. That's where tax policy is going to get passed and negotiated. So it's coming. They already dealt with tax policy in 2013 for individuals. Corporate taxes rewriting is going to happen probably in 17 and 18. So be careful. And Hillary's already said that she's going to lower the state tax ceiling from 5.23 to basically 2.5 million, and to raise the estate taxes from 40% to 50%. And they may go after capital gains, they may go after 1031 exchanges. Everything will probably be on the table along with cash value life insurance. Because we have basically $19 trillion in debt outstanding, and we run a budget deficit of roughly $250 to $500 billion per year. Canada, they're fine. Brexit, major restructuring going on in Europe right now, major restructuring going on in the UK. Financial institutions are moving their financial centers out of the UK, out of London to other parts, probably Brussels or probably to Germany. The 10-year Treasury yield dropped at about, right after the Brexit, dropped at about 1.53. Currently, the 10-year Treasury is about 1.83, so you've seen about a 30 basis point increase in interest rates since basically the Brexit. And those interest rates, the interest rates will probably continue to go up. And the Fed's obviously threatened to raise interest rates in December, although they probably won't. But again, you're already seeing higher interest rates, which means that the cost of capital for mortgage, debt, and equity is also going up. France, not a big deal. Italy, probably a banking crisis. Greece is a basket case. They can't devalue their currency because they're part of the EU to try to grow their way out of their recession. Spain, basket case. Russia, don't get me started. I mean, they're in a recession, the ruble's devalued, they have military expansions, and obviously there's other issues with Russia, and their economy is under major stress because of the value of the oil. The price of a barrel of oil is down at least 50% over the last 24 months, and was down as much as 70% within the last year. Middle East, you have Turkey, which is basically Erdogan I think we still have emergency rule there. Saudi Arabia has issued their first sovereign debt because the price of oil is now creating budget deficits. So you'll probably see them start to issue more debt in desperation to finance their public sector. Egypt, banking crisis, probably a failed state. Syria, failed state. Libya, failed state. Iraq, failed state. Afghanistan, failed state. Pakistan, India has actually continued to grow. It seems like one of the most healthiest economies there, but again, the battle between the two states, the two countries, continues to create a lot of uncertainty there. Latin America, Mexico, lots of crime. You have a lot of drugs coming into the United States, and you have a lot of influence. And now with legalized marijuana, who is running that? I don't know. I bet those guys are figuring that up here too. Brazil, recession, political disaster. Argentina, political disaster, hyperinflation. Venezuela, on the verge of total collapse. You have people in poverty there going through garbage cans, hyperinflation, total freaking disaster, and the global community is doing nothing for them. It's a total disaster. Southeast Asia, China, decelerating in growth, although I think it's stabilized, but that's probably where the financial crisis will emerge, because we really don't know the quality of the loans. On the money center banks there's no transparency, they're not publicly traded. So we really don't know the impairment or the loan losses or anything in regards to those loans. There's a lot of bankruptcies going on, and there's bond defaults occurring too. And they continue to print money and just buy the bonds and really sweep a lot of the problems underneath the carpet. Although I do, and I was talking to a group of Chinese businessmen and government officials over the last couple months, and I recommended that they put together a very thoughtful privatization program to basically take a lot of the government corporations and take them public and bring in foreign operators to basically take them over and capitalize the system and start to build an efficient stock market and corporate bond market through a nationalization wave. And if it's done ethically and not the way the Russians did it, there will be massive wealth effects and maybe bring more people out of poverty in China. Japan, total basket case. Negative interest rates, been in a recession 14 times in 14 years. The Bank of Japan basically has printed money trying to create inflation, really with no effect whatsoever. Massive fiscal policy stimulus, really with no effect on GDP or real wages or even nominal prices. So their stock. Hong Kong, Singapore, some political unrest along with Malaysia. North-South Korea, again, go back to the Korean War, and again, the North Koreans actually launched a couple missiles within 100 miles of Hawaii and China, so again, very unstable there. Australia has been held up. They haven't been in a recession for like 20, 30 years. So, but asset price bubbles due to massive amounts of capital coming out of China. Same thing here, massive amounts of capital coming out of China into the commercial real estate markets, particularly the top 5 markets, because it's really easy to hide millions or billions of dollars into very large assets. And all of my friends in development and a lot of people I know who are doing stuff in real estate are all now have Chinese backers, have Chinese capital funding them. South Africa, total disaster too. ANC just did nothing for them. And there could be political unrest there too. So if you kind of look at the globe, you know why now massive capital flight into the United States is occurring. Because it's the most stable, it's got a relatively stable political system, you have enforcement of private property rights, efficient markets, you can own title to property. So there's all these factors that basically make us the best place to bring capital into and to invest. That props up the dollar, they go into bonds, that props up bond prices and keeps interest rates low, and that's been very stimulative for the economy. I don't know if I'll be able to get through everything, but I read this to everybody. Efficient real estate and security capital markets require strong public and private sector cooperation, disclosure of government and corporate financial conditions, and institutional and individual investor confidence in both the financial and political institutions. If you do not have that, you are going to have a misallocation of resources. You're going to have underproduction, underemployment, you're going to have lower falling real wages, and low and falling standards of living. And we are basically in that point where there is a lack of confidence in not only our financial institutions. I mean, just look what Goldman and Merrill and Wells and B of A and all those guys have done, and then the government institutions too. I mean, this political cycle, particularly at the presidential level, is probably the worst that's ever been in the history of the United States in basically destroying the political institutions that have been built over the last 200 years. So, you know, this will affect the economy in the long run if the institutions cannot operate. So in real estate, you really need to be multidisciplinary. So to be able to forecast the value of equity, which is really the key, is the value of equity going to go up or down? You really got to know a little or a lot about the financial and managerial accounting. You got to understand finance and capital markets. You got to understand the economics and the economic regimes, both fiscal and monetary policy, what's going on. You got to understand politics and how policy is formulated, how it's enacted, and then how it's administered. Because there's going to be direct and indirect outcomes associated with those policies. Is your property and your portfolio in the path of the constructive outcomes associated with those policies or the destructive outcomes associated with those policies? And if your property and portfolio is in the destructive path of those policies, you need to do something about it. You got to move. You have a fiduciary responsibility to yourself, your client, and your family to either put in mitigating contingencies or put in contingency planning, or you need to sell or move the property or the portfolio or put in more defensive tenants in your property and portfolio to be able to mitigate the damage associated with those outcomes. And I challenge you, and I challenge the real estate community, because it's really easy to do the accounting and the finance and do the MPV and the IRR and all that stuff. But again, to conduct a political scientific analysis, to find out if this person gets in this office and if the House and the Senate are controlled by this party and these people, what are the policies that are going to be formulated, which ones are going to be enacted, and who's going to get hurt and who's going to benefit. And if you're going to get hurt, you got to do something about it. And if your clients are going to get hurt, you got to do something about it, because you have a fiduciary responsibility. The financial crisis created a dialectic. People like to talk in cycles, but the financial crisis was probably the biggest event post-World War II, and you can even go back 150 years. It was basically analogous to a world war. The same amount of money and the same number of people have died. And it basically has launched a shift in political arrangements and political, ideological, and philosophy going forward. Now, government institutions between each other are starting to realign. The relationships between governments and corporations are changing. Between corporations are changing. Between governments and citizens, and between corporations and consumers. We are in the path of a realignment. And I went back and I basically traced out 3 dialectics, and they last on average 30 years. So if the financial crisis would basically set off a dialectic, we are in the first 9 years of the first 15 years of a 30-year dialectic. Why is this important other than just philosophical cocktails? Because institutions and families invest on 30-year time periods. People have 30-year careers. They got to be anticipating what the environment, both economically and politically, will be over the next 30 years to be able to navigate through and to be able to accumulate their assets and then protect them and to be able to distribute them in the future. You got to know where to put your money. And if you understand that we are in this path of change, we have to be watching for change. And again, we have to move. We have to take the responsibility to protect ourselves. The political spectrum, I watched it, I mapped it out, I used public choice theory and mean voter theorem. There's been a rightward shift in political ideology, starting with really Carter. You really saw it, you even saw it with Kennedy. It basically accelerated under Reagan, and then and even Clinton moved the Democratic Party to the right of center, took out the moderate Republicans and won the election. And then Bush too basically won his election from the Supreme Court. So it wasn't even a populist vote. And when he got it, he even moved the political spectrum even further to the right. And then you saw the NRA, the Christian Coalition, the Tea Party then emerged, fractured the party, Trump's come in, and I don't even have him on this frickin' spectrum, because I should put him over here somewhere into the ultra right-wing sector, and he's got the alt-right on his side too, which is really scary. But again, you can't win general elections, particularly the president, when you're this right of center. You got to move towards toward that far right. You can win elections from the right of center, and the majority of the policy needs to be in the center to really create benefits for the overall population and the economy. So Romney and McCain and those guys, there's no frickin' way the Republicans will ever win a presidential election, because their party is so far on the right, and now it's been fractured 2 times. Okay, one by the Tea Party, one by Trump. So they're going to have to go back and figure out who they want to be when they grow up, and try to, remobilize and narrate who they're going to be able to compete at the presidential level. But it looks like they can't compete at the state level and the local level, and that's where the battle is really coming in right now, is really for the Senate and for the House. And we'll see. I mean, the Republicans win the House and Senate, and Hillary wins the presidency, we may be looking at gridlock for another 4 years. Okay, so total disaster. Why is this all important? Because from my view, if we're looking at the value of real estate, those political uncertainties and the political risk premiums are embedded in the discount rate. And we don't take into consideration political and policy risk premiums when we're building the expected rate of return. And since these political and policy risk premiums now are so volatile and so unstable, it's having an effect on the discount rate. So imagine if you're an investor and you, one day you're conducting your analysis and you have a net present value that's positive, you go, great, I can do the project because I'm going to get a rate of return that's higher than my expected return. Okay, I'm going to do it. Then something happens and all of a sudden you rerun it and now you have a negative NPV and you have to reject the project. So the volatility now in the discount rate is creating volatility in asset prices in commercial real estate, which was never the case prior to 1995. So over the last 10, 20 years, real estate as an asset class has become more volatile. It will never be as volatile as stocks and bonds, but again, it has become more volatile, and it makes it harder to make investment decisions when you have volatility in your asset prices. And you got to be really, really smart and know when to buy, when to sell, and since we can't use other types of hedging products, it just makes it more difficult to make decisions, and you really got to make them at the local level. And it was really easy to build portfolios of real estate too. That's all you had to do was add assets to your portfolio whose returns were not related or correlated to each other. So you could get rid of the non-diversifiable risk, and that's all you would have is economic or political or systematic risk. But now, since you have more volatility, you're taking on more systematic risk. So the question is, for you as a portfolio manager, confronting more systematic risk, what is the solution as the portfolio manager? You take on more non-systematic risk. You look at your clients, 80-20 rule. I'm going to focus on the 20 clients or the 20% of my clients that are generating the 80% of my revenue, customer service. I'm also going to re-look at my business plan and my processes, and I'm going to optimize them to become more efficient. I'm going to hire the best people, I'm going to employ the best technology, and I'm going to focus in on the local markets that I'm an expert in, and I'm going to focus in on the assets that I'm the best at, and really drive and push down the systematic risk by really focusing in on the microeconomic markets. When you add real estate to your stock bond portfolio, it'll reduce the expected return, but it reduces the risk even more. So alternative assets have become so popular right now because there's so much volatility in the stock and the bond market. And the best alternatives that I've seen in going forward is going to be cash value life insurance. And banks already have bank-owned life insurance, so they've already institutionalized it. 10% of your portfolio should be in real estate, private equity direct, preferably because publicly traded REITs are already highly correlated with stocks. And alternative renewable energy, this is the emerging market. It looks and smells just like real estate. It looks and smells just like real estate. It's long-term asset, durable cash flows. That market will probably capitalize and become even bigger and bigger, both public offerings and public offerings too. So that's another market you want to look at. That's my target model portfolio for risk-averse investors for the next 20, 30 years. Where's the risk coming from? Inflation risk. Just look at the volatility of oil prices. Look at the volatility in food prices. You can really see the volatility in oil really hit in 2000 when Bush came in. And then really over time, Wall Street started raising commodity funds and trading in futures and option contracts and forward contracts and manipulating the market and actually setting oil prices through derivative contracts and not through supply and demand in the spot market. So total manipulation. And those guys have actually backed out of the markets, and you can see when they started backing out and selling off how it just cratered that commodity market. Gold. A lot of people go into gold because they're scared and they want inflation hedge, and they also want to protect their money against inflation. So gold has always been a good place to put money, and you can see the fear factor really kind of take hold really after the financial crisis. Massive amounts of money go into gold, and then gold reached its peak. The stock market was undervalued along with the real estate market. They sold off the gold, went into stocks and real estate in arbitrage. And if you would have rode this thing down over the last 24 months, gold is up like 200%. So if you could do the technical analysis and figure out when gold was bottoming, you probably made some pretty good money over the last 24 months. And just volatility in the stock market. I mean, you can see it was pretty high in 01, 03, and then it tapered off, and really the recovery phase of the business cycle, and then 08, 09, volatility spiked out of control. It started to taper off, but we're now seeing more volatility in the stock market now. There'll probably be a sell-off at some point because the stock market's in a bubble. Okay, you've got massive over-accommodation by the Federal Reserve. They should have raised interest rates a long time ago. They didn't do it. And now the S&P 500 is well above its peak of 06, 07, and its prior peak in 98, 99, 2000. Way above its peak. So it's well above the technicals. And I don't see the fundamentals to support the earnings growth rates by corporations. I mean, their profits have been down for, I don't know, 8 or 9 consecutive quarters, and the stock market continues to go up. It's not driven by fundamentals, it's driven by excessive accommodative monetary policy. So when the Fed starts pulling back, expect a correction. And I'll show you they're already starting. Deficits, that's one of my biggest concerns. I mean, we don't have enough tax revenues, to basically fill the budget deficits. So we're going to continue to run 250, $500 billion, maybe even $1 trillion of debt per year that we're going to need to raise in the capital markets. And all that $1 trillion that's going to service and fund the government is not going into corporations, it's not going into expansion, it's not going into human capital, it's not going into assets that are going to produce benefits or income streams over the next 20, 30 years. You're going to support basically government finance. So there's a massive crowding out effect. And that's one of the reasons why productivity at the labor side has been deteriorating and is negative, is you don't have corporations investing in capital, or labor, period. So there's some structural problems in the economy that will come to roost at some point. You can't just continue to push it down the road. The yield curve is probably the most important thing to look at, because all debt, all equity, all real estate assets are priced off of the yield curve. The yield curve is basically the interest rate by maturity for government debt. All debt, all equity, all real estate, cost of capital, are all priced off of the yield curve because that's the base rate. What you want to watch is that this is an upward sloping curve, okay, which means that inflation expectations are positive, which means we're not going to go into a recession. We never go into a recession when the yield curve is upward sloping or normal. It's when the yield curve starts to flatten is the first indicator that we may be moving towards a recession. And when the curve inverts, you have 12 months until the stock market peaks, in 24 months until we're in a recession. I went back, I did the analysis, 12 months, peak in the stock market, 24 months later, recession. This may be the first time in history, because it's happened in Japan, where we may fall into a recession without an inversion in the yield curve. In the yield curve, inversion has like a 90% probability of predicting recessions. So it's a really good indicator of predicting recessions. Problem is that the Fed is buying massive amounts of bonds on the short end, holding the yields at 0, so manipulating the market and not letting the yield curve basically do what it's supposed to do. So our monetary system and our economic system is controlled by the Fed currently. It's not a market-based system right now. It's basically a financial authoritarian system, really, from what I can tell. And then negative interest rates is what keeps me up at night. If we go into negative interest rate environment, you're going to see disintermediation in the banking system. People aren't going to hold deposits at the banks anymore. There's not going to be enough money to be able to lend out it for mortgage finance or personal business financing. And if you're not lending money out, then the economy comes to a screeching halt. Okay, so there's major institutional structural problems that need to be addressed if the Fed goes to negative interest rate policy. And Yellen has actually threatened to start buying corporate bonds in corporate stock. So they're going to print money, and they're basically going to take control of a significant portion of the public markets. That frickin' keeps me up at night. Makes me want to call them up and scream at them, because it's a total violation of democratic capitalism. Real estate's a great asset. The spreads are still wide. This is the risk-free rate, and that's the cap rate. Spreads are still wide. If we do go into negative or 0 interest rate environment, those spreads will be maintained. Capital will continue to flow into real estate. Prices will be propped up well above their intrinsic value, which basically means you're in an asset price bubble. And at some point in time, when the Fed decides to start pulling money back out of the system and interest rates go up, the asset price bubbles are going to pop. And it's going to be the stock market, and it's going to be the commercial real estate market, particularly in the top 8 markets. and you tell me that real estate in San Francisco is not overvalued, give me a break. Or New York or Boston, those markets. So one of the things that I really had a problem with was trying to figure out why the economy wasn't growing over the last 9 years. I mean, the Fed's trying to target a growth rate of 3 to 4% in gross domestic product. They're trying to target inflation at 2%. Actually, the average growth rate for gross domestic product over the last 3 to 5 years has been around 1.5, so they're way off their mark. Inflation is running around 1 or 1.2, so they're not hitting the 2% target. And this is the equation that I use. It's called the quantity theory of money. It's gross domestic product times the inflation rate equals the velocity of money times the money supply. So to get to a 4% gross domestic product and a 2% inflation rate, which is their targets, you got to grow the money supply from what I figured out at 30%. You got to be printing money and growing the money supply at 30% to get to those targets. And we were growing the money supply at that rate in 2008 and 2009 when we were in the financial crisis. Currently, we're growing the money supply at about 5 to 8%, so the Fed's not doing their job, okay? And one of the reasons why the printing of this money is not working is because the velocity of money, which is the number of time money circulates in the economy, has basically collapsed. Okay? So the problem is not money supply growth, which I do have an issue with, it's in the velocity of money. The velocity of money is basically broken, okay? And the reason is because they can't control the money supply anymore. They print all this money and it shoots out to the shadow banking industry, it goes out to other parts of the world through high-speed telecommunications. They basically are not putting enough money into labor, productivity, that's negative. Participation rates are at the historical lows right now. We're not, if you're between the ages of 45 and 65 years and you're a male of any race or any culture, you're probably outside the labor force, which means that all that money that those people could be producing and consuming and saving is just not contributing to GDP. You have falling savings rates, you have high debt, so a lot of the money that they are making, both corporations and individuals, are going to service debt. And then you have a lot of people that are really freaking scared. And the money that they are making, they're not putting it at the bank, they're keeping it in cash or near cash as precautionary balances in anticipation for the next downturn. And you look at corporations, there's like, what, 3 to 6 trillion being held by corporations as dry powder. Individuals are holding huge amounts of cash to get through the next down cycle. And if the next recession is anything like the last one, it lasted 4 years. And on average, most recessions only last 2. So you're going to need at least four years of money to basically get yourself through. And the number one factor that actually solves the velocity of money is labor policy. Now, you can print $5 trillion to bail out the banking system, but only issue through fiscal policy $1 trillion for labor policy. So basically labor and labor policy is totally underfunded by at least $3 trillion. And you're hearing the rhetoric from the presidential candidates that are saying we're going to do infrastructure spending. That's not going to be enough. You need massive labor policy focused not only on jobs, but job training, education, and healthcare to be able to pull this economy out over the next 10, 20, 30 years. And again, the battle between capital and labor has been going on for hundreds and hundreds of years, and capital wins in most cases. But you really need labor policy if you want GDP to go up, if you want jobs, if you want higher wages, and you want higher standards of living in this country. And again, nobody's talking about it. They're not talking about it. And there's your velocity of money. Totally collapsed, broke through the 1965 support in 2011 and continues to go down. This is across the globe. So it's a velocity of money problem. And it needs to be fiscal policy, monetary policy, and labor policy to fix it. And again, I don't hear it. Quantitative easing, this keeps me up too. The Fed used to hold about $250 billion in Treasury securities to buy and sell, to regulate bond prices and interest rates, to cool and stimulate the economy. Okay, they could do it. But in 2008, in the financial crisis, the Fed basically printed, I don't know, $4 trillion, to bail out the banks and buy all that crap off their balance sheet, and recapitalize them, and make sure that our banks didn't go insolvent, and there was massive run on the banks. So they did what they had to do, but it cost us $4 or $5 trillion, and it probably cost us the same amount on the fiscal side. So the total cost of the financial crisis was probably around $10 trillion. And over the next 30 years, if you do a projection on it, it's probably going to cost us a total of $30 trillion. We could have done a lot with that money. We could have done a lot. And who owns the majority of the Treasury securities now, the government debt? Well, the Federal Reserve does. They own almost $3 trillion. $3 trillion of the Fed's money. They own $2 trillion in residential mortgage-backed securities. They basically saved the housing market. Thank you, Fed. But this debt is going to mature, over $1 trillion is going to mature in the next 5 years, so there's going to be reinvestment risk. So that actually could put upward pressure on interest rates as they go back into the marketplace to try to refinance this debt. So again, it just points to higher interest rates by 18, and maybe a recession by 21 through 23. The Fed doesn't even have to raise interest rates, even though interest rates, the 10-year is up 30 basis points, is you have the balance sheet that's starting to contract. The Fed has grown the money supply, the reserves, the balance sheet, which has been good for commercial real estate and stocks, but now the monetary base is starting to shrink. That's basically a restricted monetary policy. Okay, when you have restricted policy, there's less liquidity. So it's going to impact commercial real estate at some point in time. It just has to, by historical standards. The business cycle, again, like I said, if you go back and look at the prior cycles, recessions last on average 2 years historically. This one lasted 4 years. It was twice as deep, twice as long. In some parts of the United States, will never recover. Permanently damaged, permanent dislocation of industries and demographics in pockets across the United States. So again, you need labor policy or some kind of economic policy to bring those back. And here you have the GDP numbers, and you can see how severe the last one was compared to the others. And again, this is man-made. This was due to deregulation of the banking industry, allowed the commercial investment banks to merge. They basically took the depositors' money and the equity, levered it up using derivative products. And then when the whole system imploded, the Fed was nice enough to buy all that shit off their balance sheet and bail them out. It was great. They did a great job. Why am I saying the 2018, 21 through 23? Well, here's the data right here. This is non-farm employment, year over year on a monthly basis. I hacked it up into 10-year increments and then hacked it up into 5-year increments within the 10 years. I analyzed it, coded it. We've had recessions 90% of the time within the first 5 years of every decade. We were in the growth peak phase of the business cycle 75% of the time in the last 5 years of every decade. It's persistent. So the 08 recession was an anomaly. The only time we've had a recession in the last 5 years of the decade was 1958 and 1928. So there's a higher probability now. And the 2021 through 23, I got a 90% probability. So you need to put your tactical plans in place right now for the next 2.5 years in anticipation of 18, and you got to put your strategic plans in place right now because 2021 through 23 is only 5 years away. So you have to start thinking now on what you're going to do. And if you don't, again, you're going to be negligent. I won't say incompetent, but negligent if you're not doing the planning that's in place. What markets do I like? Obviously downtown San Francisco, San Jose, the 680 is a great market. 880 as you move closer to Emeryville. Fremont's a good market, obviously. Hayward, San Leandro, San Lorenzo, again, you're going to have to take more risk to figure out that market if you want to go there. Oakland, I don't know. I mean, I grew up there. I was born there. I mean, it's probably a good opportunity. Kind of reminds me of Brooklyn approach, but again, it has major political, institutional, public administrative issues, and you just have a disaffected and stigmatized social pathology by the African American community that have been basically victimized by the community and by the state for years and years and years with no redress or any kind of resources to help them out. So why wouldn't you resort to riots and crime for survival purposes? Pleasanton, obviously Hacienda, Bishop Ranch, and San Ramon, Walnut Creek, and obviously Pleasant Hill as the progression moves north towards Concord. Palo Alto, I mean, come on, you know, ground freaking zero, isn't it? Ground zero. And now you're seeing the progression into East Palo Alto. If you want to go to Sacramento, Davis, around the university, I recommend. As close to the capital as possible, I recommend. And if you want to play a little commodity market and some progression, I'd go up towards Roseville, Rockland, and maybe Lincoln. A lot of demographics up there if you want to play in that market. But again, a lot of land, so you have supply shocks and supply risk that could come back to haunt you at some point. And then I would actually look at Monterey too. I would definitely look at Monterey and the Salinas Valley for industrial opportunities, because basically at least $8 to $9 billion of economic output comes from Monterey County alone in agriculture. It is one of the most capital intensive and mechanized and corporatized agricultural industry anywhere in the United States. And just the profit margins and the land opportunities there are off the charts, especially for housing and industrial flex or industrial buildings down there. And people don't even know that. You go down there, everybody's walking around with cowboy boots and a cowboy hat and shit on their boots and stuff, and those guys are all millionaires. You wouldn't even know it. It's amazing. It is just freaking amazing. So let's go through the economic, how much time?
10 minutes.
Okay, perfect. Okay, perfect. So we're at full employment in regards to unemployment. It's basically at 5%. I'm not worried about unemployment rate, top line, you know, front line unemployment rate numbers. I'm worried about underemployment. Okay, and underemployment is double the unemployment rate. Okay, and unemployment is basically people with education and job skills that are working jobs below their skill sets and their education. And that's one of the reasons why real wages are so low, is you have high underemployment. Labor participation rates I'm concerned about too. They're at historical lows, even with full participation of women in the labor force. The labor participation rate used to be as high as 72%, 75%, it's now at 65, 62%, and even dropped down to 58%, because you basically have aging males, different races, that have basically left the labor force and cannot get a job, period. So and right now, actually, labor participation rates are going up for the first time in a long time, and that's what Janet Yellen has been looking for by holding interest rates at 0 to stimulate the economy, is to try to get people back into the labor force now that there's labor shortages. But there's massive mismatch between the skill sets of the jobs that are being offered and the skill sets of the people that want to get back into the labor force. That's education and job training. Policy, and again, you don't hear it. Job growth in the Bay Area, unbelievable. Unbelievable. Last 2 years, over 100,000 jobs. Last year, 150,000 jobs. Year before, 100,000 jobs. This year, we're probably looking at another, I don't know, 115,000, at least another 100,000 jobs. It's the highest it's ever been since 1998, 99, and 2000. And for you older people in the audience, now that I'm getting older, I remember those cycles, and that was an amazing time period. And this last tech cycle is even bigger than that tech cycle, which was a huge cycle. And there was no tech cycle in 2004, 5, 6, and 7. Okay, they skipped a generation basically. So tech is basically where it's happening, what's driving the jobs. Not only can you diversify your property portfolios by location, which I highly recommend, but pick your submarkets correctly. I love supply-constrained markets with really good demographics and socioeconomics. But I can also diversify my portfolio by industry concentration, agglomeration, concentrations of firm by industry, because they all want to cluster together. So if you want a high-tech biotech, you can go over to Berkeley, you can go down to San Diego. If you want alternative renewable green, you can go over to the 680 corridor, huge concentration of energy firms in Bishop Ranch. Healthcare, get as close to hospitals and universities with medical centers. The demand for healthcare is not going down, it's going to go up. Okay, so that's a defensive strategy. Financial services will probably continue to contract. Venture capital is already down 40%, so Sand Hill, Page Mill. Telecommunications, Denver, Marin, AT&T, those kind of telecom companies. probably going through some restructuring. Multimedia entertainment, I get it as close to the Presidio next to Lucas, which is now Disney, so go to LA and hang out, down there. Get exposures to the motion picture industry. If you want internet and software, that's San Francisco, Silicon Valley. Trade, tourism, San Francisco. Construction, engineering, probably San Jose and San Francisco. Education, government, go to Sacramento, get as close as you can to the capital. Defense, El Segundo, Silicon Valley, and with what's going on globally with Russia and North Korea, you'll probably see increased or sustained defense spending of roughly about $1 trillion a year. Okay, I don't see that going anywhere. And then ag timber. I guess everybody's going to be buying, I don't know, publicly traded marijuana REITs at some point here in the future. If you see maybe I can help on the IPO. Okay. In international trade, I mean, San Francisco and LA, and to a less degree, I would say you can even throw in Seattle. But San Francisco, I believe in LA, and people have said Singapore and Hong Kong and Tokyo. But I really do think that San Francisco is emerging as basically the center for the Pan-Pacific region. Basically, we face the fastest growing economies in the world, and the velocity of human capital and capital within this region is continuing to accelerate, and the velocity will continue. I mean, I'd rather be here than in New York facing Europe and Latin America. I'd rather be here facing Southeast Asia and Asia, where the opportunity for capital and return on capital is really there. So we're going to have to build institutions to be able to cooperate, both economic and political institutions and educational institutions, to be able to create those relationships so that we both benefit mutually. And that'll be a challenge for us. Particularly, there's a major language barrier and cultural barrier. Another strategy is let's invest next to ports, airports, trucking terminals, intermodal operations. This is what Prologis did, or A&B did. A couple decades ago, or at least 15, 20 years ago, they basically changed their model to a global intermodal strategy, portfolio strategy, and started buying up and building properties that were close to particularly the ports of LA and Long Beach, ports of Oakland, ports of Seattle, Portland, San Diego. Although LA and Long Beach that's frickin' ground zero. I mean, 40% of all exports go through the ports of LA and Long Beach. If you add in Seattle, Portland, Oakland, those guys, 50% of all gross trade flows in and out of the United States goes through Western ports. Okay, you can play that strategy on the East Coast too, but this shows the economic impact from the ports of LA and Long Beach. So you buy your properties along these arterials, which is the most intensely used trucking and intermodal arterials. That's where the highest and best use of the property is going to be. That's where the highest land value is going to be. And you're going to go in and you're going to recognize that property, that improvement sitting on the property has been completely depreciated, is completely physically deteriorated, and you scrape it and you build something of a higher and best use. And then A&B obviously proved that concept is a winning concept. Technology, California, epicenter for technology. Non-residential fixed investment has improved, which is basically all the money going into equipment. Semiconductor sales have dropped this year, but they're expected to improve next year. And venture capital flows. This is the canary in the coal mine. The United States has raised between $10 and $13 billion per quarter for the last 2 years, okay, in venture capital funds. Silicon Valley historically captured 30 to 40% of it. In the last 2 years, they've captured 50. If you add in other parts of California, Orange County, San Diego, Oakland, Sacramento, those areas, California captures, from my forecast, 70% of all risk-based capital in the United States. So obviously we have comparative advantages in education, skill sets, infrastructure, location, quality of life, all of the attributes that basically bring the best and brightest to our location. The bad news is that venture capital flows are down significantly. They're down around 40%, quarter to quarter and year over year. So basically the tech cycle, venture capital cycle is over. Okay, the tech stock price cycle is over. And the real estate price rent cycle is over too. The real estate prices and rents peaked, and they're highly correlated, at the end of 2014 and at the beginning of 2015. The prices and rents are continuing to go up, but at a slower rate. So they're increasing at a decreasing rate. So they will reach an inflection point at some point. And now's probably the best time to cull the portfolio or look for other exit strategies to take advantage of the liquidity that's left in the marketplace. You'll probably get a bump after the election due to euphoria and some kind of Hawthorne effect. But again, I think the reality will start to set in at the end of next year, and when the new Congress comes in and starts working on tax policy, and they do enact it, and if they do, there'll probably be a lagged effect and hit in 2018. And interest rates will probably go up in 2017. There's a year lagged effect on that one too. So everything starts to point towards a mid-cycle correction by 2018. It's not gonna, I don't think it's going to be severe because the Fed will be there. But again, if you keep kicking the can down the road, it's going to hit in 2021 through 23. And you know, LA, San Francisco are the hot markets, you know, on a global basis. The Western regional metros rank high across all the property sectors. San Francisco, San Jose, I mean, you see office rent growth in the 8, 10, 12 range. Again, that'll probably slow as the new supply comes online. And again, we are seeing lower rents on apartments in San Francisco as the new product hits and they're giving away concessions to incentivize people to move into their buildings. And there's more coming. This will be the biggest construction cycle since probably the 80s. And it won't be fiscal policy driven or tax driven through accelerated cost recovery systems. It'll be monetary policy that stimulates the overbuilding and the peak in the prices. And then San Jose, again, vacancy rates in office at about 9%, so it's underneath the structural vacancy rate, which means rents will probably continue to grow until new supply comes on or the tech sector starts to lay people off. And Twitter's already announced that they're laying people off. So that may be just an indicator of some of the tech stress that may be coming along with the venture capital flow declines. Let's get to the, I stole these slides from Robert Salmons. He's the director of research at Cushman Wakefield. But if you want a copy of the presentation, give me your business card and I'll send it to you. And then you have to meet with me and buy life insurance from me. Everybody needs life insurance. Okay, so I built a model. I get asked all the time, where do I invest my money? So I built a model, a quantitative model based on economic and demographic and market factors, so very quant-oriented. And then I did a survey model too, and I asked a bunch of people where the best markets were, which ones had the best pricing over the long run, the best rent appreciation rates, high quality of life, blah, blah, blah. And then basically plotted the markets, the sub-markets by quant score and survey score, and basically said, here's your Class A sub-markets right here. These are the markets, AAA rated, AA rated markets, that if you put your money into, you'll probably do well over the long run. And that's obviously Mountain View, Los Altos, Central San Mateo, Russian Hill, Embarcadero, Sunnyvale. This is an apartment model, but it's also correlated to housing, and you could and the commercial markets all correlate together. Marina, Pacific Heights, South of Market, Fremont, Newark, Walnut Creek. Does this all make sense? Yeah, so this is, what I did was I built this to be able to show the board of directors and the investment committee and senior management that these are the markets that we should be focusing on for long-term price appreciation and return for my investors. And then with, the markets that scored low on the survey, scored lower on the quant model, these are probably your value-add markets. And then the ones over here, you know, with lower demographics and fundamentals and maybe supply shock factors, and you just don't have the strength. These are your opportunistic markets. So you get in there and you get out. You get in, you do what you need to do, you maximize the value, and get the hell out as soon as you can. Okay, you're going to hold those forever, and you're going to get in, get out over here. And then these markets, especially markets bordering these core markets, the progression is going to emanate out from the core markets. So there's your opportunities right there if you can project the progression out from those core markets over time, and then have the guts to do it. And you can see these are the core markets right here. And obviously the west side in the peninsula is number one. It's hard to get in there. But again, you're smart. You figure it out. You get in, you buy, you hold, and you maximize the value. And you hold. Don't sell until you run out of depreciation. Then talk to Ron. Talk to me. We'll get you out somewhere. I can't get you out until 1031s. The market's just too much. There's too many people already there. So I'll just take, any questions if we have any time.
You got any good news?
Yeah, we're in the best place in the world. And you're surrounded by really good people. And you have good markets. And I would rather be here than any place else.
You painted not the best picture on.
It's called realistic.
Yes, we'll call it realistic. But
I don't report to anybody. I'm not owned by a bank or anybody. I'm Larry Souza.
You talked about we're in a bubble. And
That's correct.
then you talked about at the same time we have these core markets that are probably long-term holds.
Yeah.
Are you kind of suggesting that if people were going to go buy now, you should buy in the core markets with very low leverage? Is that what I'm hearing?
If you're a long-term holder
Yeah.
and you can stomach the cap rates and you think that there's some upside, but if the durability and the cash flow is there for the next 20, 30 years during the depreciation period, then yeah. I mean, I'd be in Pacific Heights.
But I mean,
I'd be in the
my
marina.
point on that was low leverage because of
Yeah,
some
because
of
if
the
we
fear
go
going
if we go into an economic downturn and your LTVs go up and your coverage ratios start to drop because you're looking at lower occupancies or higher vacancies or you have certain type of exposure, tenant credit, yeah, you want to go in with low leverage to protect yourself. Hell yeah. There was a question over here somewhere. Did I scare you? Usually I get a couple people that get up and leave.
So in the banking industry, we're seeing some of our clients getting these huge unsolicited offers on their real estate.
Sure.
And so they go, wow, that looks great.
Sure.
And they're trying to 1031 them
Sure.
for their property.
It's very dangerous. Especially when you get to the end of your depreciation period and you're looking at, what, a 70% tax hit at least, if you don't time it right. I mean, with transfer and Obama and capital gains, recapture, I mean, just add it on. Just add it on.
So is this something that's out there in the market you're seeing, and is the 1031 going to dry up, or what's your thought on
Well, it's hard to find the replacement properties and close in 180 days, so, it's a big problem. Unless you want to take the risk and 1031 into oil and gas or TIC, syndicated, make sure they're conservatively leveraged. You got Cantor out there beating, the Bushes on their frickin' Delaware Statutory Trust, which I'm just like, oh no, if these guys are hawking that stuff, we're probably late in the cycle, and there's probably more of that stuff coming. That's hard to get, that's the Roach Motel. You can get in, but it's hard to get out on those things. Maybe the couple, installment or the monetary installment sale, maybe that's an option. It's very complex and it's hard to sell. Very simplistic people who are in real estate and they've been in it. It's really hard to sell alternative strategies. So it's really challenging. I'd probably say the best thing may be to, I don't know, put it in a trust. Maybe, I don't know. I don't know, it's really hard. I mean, I've been trying for a long time to figure out the best option, but when you're at an asset price bubble, it makes it really hard, and then you're forced into secondary, tertiary markets and lower quality assets, and you start chasing yield, and the credit and the quality just isn't there, and you're basically setting yourself up to get slaughtered in those commodity markets. So, I don't know, I mean, we can talk about it more, but it's a tough one.
Any other questions?
Okay.
I'll make it.
One more?
I'll make it quick. Larry Souza for president. But
No fucking way.
Wouldn't it be nice?
No way.
Wouldn't it be nice to have candidates that understood all this? I have about 8 questions. I'll try to reduce it to 1. But this negative interest rates. I don't understand the multi-trillion-dollar derivative market. But even just listening to people talk about their swaps business and how they hedge their they put a fixed rate on a variable rate, and then they hedge themselves with another variable rate, and eventually it leads up to these large institutions that have these big derivative books. I thought to myself, what happens in a negative interest rate environment? I mean, I just get a headache.
Well, the
I'm sure
negative
that
interest rates
explodes.
will basically keep those contracts in place. It's when interest rates start to rise, and if interest rates spike at some point, a lot of those contracts will be called, and a lot of the banks don't have the capital to be able to settle those contracts. So the Fed may have to come back in, and who knows, maybe print another $5 trillion to clean up their books again. Because the regulation isn't there, particularly on a global basis, because a lot of the trades and a lot of the holding of the derivatives are being held in Asia and Europe, circumventing regulation of Dodd-Frank.
Interesting, and that segues into the kind of one of the, I'll keep it quick, but the government is gonna be running $1 trillion deficits. Not to oversimplify it, but the idea is that they're spending $1 trillion more than they're bringing in, and that, you know, they're doing that by issuing another $1 trillion in debt. So every year they do that, we go another $1 trillion deeper in the hole, and most of that $1 trillion isn't going into programs that are gonna get us out of the hole. You're saying it's going into debt service on the debt itself.
Yeah, and at some point in time, they're gonna have to raise taxes to basically bring down the debt levels.
This is rule number one.
And close the deficit gap. And Bill did a great job. He ran budget surpluses during his term because he raised taxes.
And I mean, that's like rule number one of the loan that you never make. Is the borrower that can't even make their payment.
Yeah, and that's counterparty risk. And that was the biggest problem of the last financial crisis, was the counterparties weren't there to clear the transaction. They didn't have the capital to do it.
Changes in the petrodollar, all this international stuff and what you're describing.
There's realignment, restructuring going on
Yeah,
right now.
to me, it
That's
seems
what
to
it
me
is.
like that dollar hegemony is at risk right now. Maybe not?
Probably
with
not.
the influ- Okay, because the influence.
Probably not. I'm gonna hand it over there. Sore.
Well, that's, thank you so much for that. Did everybody enjoy that? I felt like I just graduated from college again. And
5 years.
what a wonderful, analysis, and thank you for sharing that. And I'm definitely going to keep 2018 and 2021 in my head. Well, thank you for being our speaker and for coming down all the way down here from San Francisco. We've got a little gift for you.
Anytime. Don't forget to give me your cards if you want a copy of this.
That's right. Give us your card. We'll send out the presentation.
Give me your birth date and your full name. An illustration.
We can have Dr. Souza leave his cards out near the table.
Yeah, you're welcome.
And just to kind of recap, some of you came in a little bit later. And we're going to have another one of these events with another speaker starting in January and every other month. And we're going to be meeting at the First American Title. So without further ado, thank you all for coming. Bye-bye.
If anybody wants to eat more, there's more food in the cafeteria.
Good job, man. Oh, I'll pay you later. Oh, yeah, of course. Yeah, that's great.
So you were out to jump off a bridge after this one?
That was in 2018.
We say hello to each other.
Pick the bridge out.
Oh, yeah? Oh, really? Just you guys? So you live in Finland? Oh, okay. That's why I got that title.
All right, take care. Thanks for coming, Nick.
You're welcome. I'll pay you later.
Don't worry about it.
So,
It's okay.
so
Okay, nice to meet you. Yeah.
Nice meeting you.
offense.
Turn off the.
Yeah. We'll put you on the